Classic patterns like triangles, wedges, or head and shoulders are just bait for retail traders, and the market is built to trap those who follow the same old chart setups. Today it's time to learn the patterns the pros actually chase. The over and under pattern, also called Quasimodo, is one of smart money's favorite setups. It's about sudden changes and traps. It all starts with a strong move up. Price makes a high. It pulls back, then pushes higher, making a new high. After that, price falls sharply, breaking below the low of the last dip. This is the key moment. Price makes a lower low, taking out stops placed by traders who went long earlier. This dip below the last low is fast, almost like someone grabs liquidity and runs. The move is deep enough to scare holders out, but instead of rolling over, price snaps back up right away. Sellers who chase the low get trapped. Now the market shifts. Price climbs, but this time, it doesn't reach the old high. It stalls and starts to turn down earlier. This creates a lower high. The over and under pattern gets its name from this exact sequence. A fake out higher high, a fake out lower low, followed by a lower high. The pattern is about the trap. Big money creates the lower low to pull in sellers and force out buyers, then reverses back up so quickly that most can't react. The new lower high is the spot where the trap closes. Here's how to trade it. When you see price drop below support and snap back, mark that low as the liquidity grab. Watch as price rises again. If it fails to reach the old high and starts to fall, this is the over and under. The lower high is your entry zone. Sell short as price turns down from this area. Your stop goes just above the lower high. If price returns above that, the pattern failed. If not, you're in for the ride down. This pattern works because many traders put their stops under the old low. When price drops and breaks that level, those stops trigger, giving big players the liquidity they need to enter or exit quietly. After the trap, the market structure changes. It's no longer making higher highs. Instead, it prints a lower low and then a lower high. This switch signals that the uptrend is likely over and a downtrend may be starting. The best over and under patterns happen after a clear uptrend, when lots of traders are caught off guard. Volume often spikes during the liquidity grab, showing that big players are active. The lower high forms quickly, often with less energy than the earlier moves up. The rejection is sharp. So to spot this in real time, watch for three things. First, a strong move up with a clear high and a clear low. Second, a sudden break below the low, followed by a quick reversal back up. Third, a lower high forming as price fails to reach the old high. When you see this, get ready. The lower high is your short entry. Set your stop above it and look for price to make new lows as the trend shifts down. Wyckoff spring is one of the most common fake breakout patterns to shake out weak traders. Picture a price chart with sideways movement. The price bounces up and down between two lines. Traders call this a range. They buy at the bottom, sell at the top. But the market has a trick up its sleeve. This is where the Wyckoff spring pattern comes in. The spring happens after a time of sideways trading near the bottom of that range. Price slowly drops right through the support line, just enough to make everyone think the range is broken. Traders panic. Some who bought at the bottom sell fast to cut their losses. Others go short, betting the market will keep falling. This is what big players want. They set the trap. Here's the key. The drop below support doesn't last. It's quick, sharp, and then just as suddenly, price snaps straight back inside the range. The bounce is hard and fast. The market shakes out the weak hands, traders who panic and sell at the worst time. This flush is not random. The large players, The ones with deep pockets use this moment to buy what the weak hands are selling. They want to buy big, but they want to do it quietly. If they just buy in the range, the price would rise too soon. So they use the spring to buy from scared sellers without tipping off the crowd. You can spot the spring by watching for a dip below the lowest point of the range, followed by a fast return inside the range. Volume often spikes. It shows big players are active. When price comes back inside the range, that's the signal. Now you want to buy. Place your stop just under the lowest tick of the spring. If price returns below that point, the pattern failed. If not, you ride the next move up when the market finally breaks out for real and price runs higher. On the flip side, after an uptrend and a period of distribution where big players sell to late buyers, you get the opposite pattern, the upthrust after distribution. The price sneaks above the top of the range, often in a sharp move. Traders think this is a breakout. They pile in, buying the new high, but then price slams back below the range top. That breakout was a fake. The big players used it to dump their inventory on eager buyers. The market can't hold the higher price. The reversal is fast and deep. This is the last bull trap before the markdown phase, where price drops hard. Both the spring and upthrust show how big players use traps. They create fake breakouts to shake out weak traders and fill their own orders. These patterns show up every day, on all markets and time frames, and they offer strong entries. That's how you know the big players are moving and the pattern is real. Volume climax followed by a tight coil is a pattern that tells you when the big players just made their move, finished their business, and are getting ready for the next big swing. Here's how it works. First, you'll spot a giant candle. It's much bigger than all the candles before it. The price shoots up or down, covering more ground in a few minutes or hours than it did all day. The volume on this candle is huge, maybe the highest you've seen in days or even weeks. This isn't normal trading. This is when big money is at work. They're either dumping a huge position, unloading, or snapping up shares, loading up. This giant candle is the climax. It's the end of one story and the start of another. Right after this, everything goes quiet. Price stops moving fast. Instead, you get a group of tiny candles. They barely move up or down. They sit in a small box, trapped between two tight lines. This is the coil. It's like the market is holding its breath. Volatility drops. Traders get bored or nervous. This is where the big players finish their work. They bought or sold what they needed, and now they're waiting for the next move. So why does this pattern matter? Because big money doesn't just smash the market for fun. They move size when they're ready for a change. That giant volume candle means they needed to get in or out fast. The tight coil that follows means the rest of the market is stuck, waiting, not sure what will happen next. But volatility always comes back. The market can't stay quiet forever. Sooner or later, price will break out of that coil. When it does, it's usually fast and sharp, and the next big move is here. The trick is watching which way to trade. The direction of the giant volume candle tells you which way the big money moved. If the climax candle is up, it means they bought in a rush. If it's down, they sold hard. After the coil, you want to trade in the same direction as the climax, because that's where the force is most likely to come back. The break from the coil is your entry. The stop goes just outside the coil. If the breakout fails, you're out quick. Volume is the key to this setup. If the big candle happens with low volume, it's a fake. Only the real heavy volume bars matter. You want to see the spike, the kind of volume that stands out on your chart, way above normal. That's when you know the big players are active. The coil should have low volume too. That means all the excitement is gone, and the market is quiet, waiting for the next jolt. Some traders call this pattern a volatility squeeze, but the combination of a volume climax followed by a tight coil is special. It tells you the market just had all the noise, and now it's setting up for the next big burst. The breakout that follows is often fast, with price moving quickly and cleanly. You won't have to wait long. This pattern works on all timeframes. You can spot it on a 1-minute chart, a daily chart, even weekly bars. The story is always the same. Big spike, then silence, then explosion. The key is to wait for the breakout. When price busts out of the coil in the direction of the volume spike, that's your trade. Gap and go pattern is loud, fast, and full of energy. Most traders freeze. Some try to fade the move, thinking the gap will fill. But in the gap and go, the market leaves those traders behind. When the market opens, price isn't where it closed last night. It's far above resistance or below support. This isn't a small gap. It's big enough to wake up momentum traders everywhere. They see it and get ready to trade. Shorts panic. They rush to cover. Buyers want in before the move gets away. The first minutes of trading are wild. This gap matters because it's not random. It comes after a long range or a clear area where price kept bouncing. The gap lasts right past that. It doesn't pause. Buyers rush in and push price even higher. Sellers who bet against the gap can't get out fast enough. The market never comes back to fill the gap. That's the key. Most gaps fill later, but not this one. The move holds strong. This pattern is all about momentum. You see a small range in the first one to 5 minutes after the open. Price chops up and down, setting its boundaries. Traders watch this range closely. As soon as price breaks out, either above the high of this mini range for an up gap or below the low for a down gap, they jump in. That's the entry. The stop goes just under the low of the small range if you're long. If you're short, put the stop just above the high. Volume is huge. This isn't like other days. It's a sign that big money is moving. The crowd wants in. The move feeds on itself. People who missed the first entry chase. Shorts who didn't cover at the open now scramble. Each new high pulls in more buyers. Each new low for a down gap brings in more panic sellers. Most traders think the gap will fill. It always fills. They try to fade it. But the gap and go pattern is different. The news is too strong, or the surprise is too big. The market moves fast. The gap becomes the new base. Price almost never comes back to fill it, at least not right away. Sometimes, you see a series of gaps like this in a strong trend. These are called runaway or measuring gaps. They show up when a trend gets even stronger and momentum explodes. Each new gap is a sign that buyers or sellers are even more eager than before. The chart looks like a staircase, jumping from one level to the next without looking back. To catch the gap and go, you need to act fast. Watch for the big gap at the open. Check that it's above clear resistance or below clear support. Watch the first 1 to 5 minutes. Wait for the range to break. Enter with the direction of the gap. Use a tight stop. If the move fails and price falls back into the gap, get out. But if the move holds, you're in the flow with the strongest traders of the day. So momentum, volume, and speed. That's what the gap and go is all about. Rounded bottom with volume divergence is one of the best reversal patterns. In this chart, sellers control the market. The chart has a clear downward slope, but then the speed slows. The drops get smaller. The bounces start to last longer. Price stops making sharp new lows and instead drifts sideways. The curve starts to look round, almost like a bowl. This is the early sign of a rounded bottom. At the start of the rounded bottom, volume is still strong. People are still selling. But as price sinks lower, the volume falls too. Each wave down has fewer sellers than before. Buyers are not rushing in yet. They're waiting, watching. The market feels quiet. This tells you supply is drying up. Sellers are tired. Big money might be stepping in, but they don't want to show their hand yet. Price keeps moving sideways and slowly curling upwards. It's not a sharp reversal. It's slow, gentle, and calm. Now here's the interesting part. The price starts to rise, but volume stays low. Most people think that rising prices mean buyers are strong. But here, the rise is soft. It's not about enthusiasm. It's about no one left to sell. The big players are quietly buying. They want to keep the price low while they collect shares. If they bought fast, the price would jump, and everyone would notice. But they want to buy cheap and unnoticed. As the bottom of the curve forms, you notice something else. Each little dip has less volume than before. Each bounce up is a bit stronger, but still mostly on low volume. This is volume divergence. Price is starting to move up, but volume hasn't picked up yet. That's the clue. It's not the crowd driving the price. It's smart money buying slow and careful, soaking up all the supply. At some point, things change fast. Suddenly, more big candles appear. Volume increases. The price shoots up, breaking above the top of the range. This is the signal. It's the moment when the big players have finished buying. Now they want the price to move. They push hard, and everyone else sees the move. This is when the new trend begins. The burst in volume confirms the shift. It isn't just a slow drift anymore. This is a real move with force behind it. The rounded bottom with volume divergence is a strong sign that the market has changed. Supply is gone. Demand is building. Control has shifted from sellers to buyers. The new trend is here, and it's not just a bounce. It's a move backed by big money. If you want to trade it, you wait for the slow curve at the bottom. Watch for price to rise while volume stays weak. When the big candle appears and volume bursts, that's your entry. The trend is ready to go. Place your stop under the lowest point of the curve. Most traders miss this pattern because it's slow. It doesn't look exciting. But that's the point. The slow, rounded shape and the quiet volume tell you big players are at work. The sudden burst in volume is their signal that the game has changed. If you spot the pattern and act on the breakout, you're with the money that matters. The inside, outside, inside pattern is not common. Most traders miss it. But when it shows up, it means something big might be coming. First, price prints an inside bar. This candle sits inside the range of the one before. It's small. It shows the market is quiet. Buyers and sellers are holding back. Some call this a pause or a squeeze. Then comes the outside bar. This candle is wide. It breaks above the high and drops below the low of the last bar. It engulfs both sides. This outside bar means there's a fight. Volume often jumps. Both buyers and sellers try to take control. The range expands fast. Anyone with tight stops gets hit. The outside bar is noisy, messy, and full of action. This is the wide part of the pattern. Right after, another inside bar forms. This candle is tight again, sitting inside the high and low of the outside bar that just happened. The market settles down. The burst of energy is gone, but tension is still there. People are waiting. No one wants to make the first move. This whole sequence means pressure is building up. The first inside bar shows the market is waiting. The outside bar is the spark. The final inside bar shows the waiting isn't over. Something is about to break loose. This is what traders call a pending breakout. Price is about to move, but nobody knows which way. But when price breaks out, you follow. If the upper range is broken, you go long. If the lower one triggers, you go short. This pattern works because it traps traders on both sides. The first inside bar makes people think nothing will happen. The outside bar shakes them up, but it's over so fast, they don't trust it. The last inside bar makes most give up. Then when price finally breaks, it's strong. There's no resistance left. The move can be fast and clean. You see this most on lower time frames, but it can show up anywhere. It means the same thing. The market is ready to move big. Patterns like this highlight points in market structure where buying and selling pressure is about to tip over. Most traders ignore this pattern, but it works. If you learn to spot it, you can catch eruptions before the crowd even notices. The pattern gives you tight levels for entry and stops. If the move fails and reverses, you're out quick. If it works, you're in when the move is just starting. The three-line strike pattern makes it easy to spot when the market is about to move fast. First, you see price moving in a clear trend, but it's slow. Each candle is small, and they line up in the direction of the trend. Maybe 3 tiny green bars in a slow uptrend, or 3 red ones in a slow downtrend. These candles show the move is still going, but it's not strong. People trading with the trend are getting tired. Some might even start to think about trading the other way. That's when the big move happens. Out of nowhere, a huge candle appears. This one is fast and strong, and it moves in the opposite direction to the 3 before. If you are looking at 3 green candles, now you have a big red candle. If you are watching 3 reds, now a green one appears. This candle doesn't just close over 1 or 2 of the small bars, it swallows all 3. The body of this big candle completely covers the bodies of the 3 smaller trend bars. This is the 3-line strike pattern. The pattern is more than just a reversal, it's a small shock. The market was drifting, and then someone stepped in with force. The big candle shows a sudden change in control. Buyers or sellers who tried to fight the trend are now wiped out. The pattern tells you there's energy building up. The trend looked weak, then got hit by a big move the other way. Now you simply mark the high and low of the engulfing candle. These 2 prices are now your channel, and you wait and focus on the breakout. Watch for price to push above the high of the big candle or drop below its low. That's your trigger. If price breaks out above the high, you enter a long trade. If it breaks below the low, you go short. Don't guess which way it will go. Let the market show you. As soon as the breakout happens, you enter with the move. Your stop is simple. Place it just on the other side of the channel. If you buy the breakout above the high, put your stop just under the low of the big candle. If you sell the breakout below the low, your stop goes just above the high. This keeps your risk tight. The 3-line strike pattern tells a story. Small candles mean the trend is running out of steam. The big candle means a fight for control. This strategy works because the big engulfing candle is a signal that something important has changed. Big traders just made their move, and now the rest of the market reacts. The channel gives you clear levels to watch. You don't need to guess or hope. You just wait for price to show its hand. Hidden divergence is a pattern that most people miss. This pattern happens when price and an indicator like RSI or MACD don't agree. This is not regular divergence, which usually signals a reversal. Hidden divergence points to the trend continuing, even when price action looks tricky. It's a pattern pros use to spot real momentum before everyone else. A bullish hidden divergence happens in an uptrend. Price pulls back and makes a higher low, but it doesn't drop as far as before. But the indicator makes a lower low. This means that, even though price held up, the indicator dipped more. The hidden divergence says the uptrend will likely continue. You look for this when price is near support in an uptrend. If you spot it, you can plan to enter long trades. betting the trend will keep going. Bearish hidden divergence shows up in a downtrend. Price bounces making a lower high, but the indicator makes a higher high. The indicator shows more force, even though price couldn't break past the last high. This is a sign the downtrend wants to continue. You look for this when price is near resistance in a downtrend. If you find it, you can plan to enter short trades, following the main trend. The steps to spot hidden divergence are simple. First, mark the trend. Look for clear up or down moves. Second, wait for price to make a swing high or low. Third, compare these points to your indicator and see if price and the indicator disagree. So price makes a higher low, but the indicator makes a lower low, or price makes a lower high and the indicator makes a higher high. Hidden divergence tells you something about the market that price alone won't reveal. It shows when the crowd tries to fight the trend but fails. The indicator exposes this hidden strength. You don't see it on price bars, but the oscillator drops important clues. The market might look weak, but hidden divergence says the trend is still alive. You can trade hidden divergence by entering in the direction of the main trend. For bullish setups, go long when price starts to rise after the divergence. For bearish setups, go short when price starts to fall. Use the last swing high or low for your stop. This keeps your risk small, in case the setup fails. This pattern works on any market, but it's best on clear trends, not in choppy sideways action. Now, if you're ready for more interesting trading guides, go ahead and watch one of these videos next.